This is just kind of a basic video, nothing fancy, just to go over the performance of the first two forecast sets that were initiated with the forecast window being from March 21st through April 18th, which is actually today, although this data is through last week through Thursday because Friday was a stock trading holiday and I'd forgotten about this, but it's still applicable. The prices won't have changed very much. So just real quickly, what this is a neural network, a series of neural networks that attempt to predict stock movement in the next 20 trading days. So they look over the price action over several months of a stock, goes into the neural network, and then it outputs the stock strength over the next 20 trading days. And then from there, the system selects the ones that had the highest chance of performing really well. It's a lot more complex than this, but this is it in a nutshell. It's analyzing the price profile and then comes up with a signal strength. And the neural networks are actually teamed. So it's consensus solution by teaming of the top neural networks, which I call supernets. And these plots right here are basically the forecast windows for a year. So TW stands for time window. I should probably change that to forecast window. But anyway, time window of 20 trading days, which is almost a month. So it fits really well within a year time frame. And this shows the historical forecast test for a particular year. It's like 11-year period. And we do this testing to try to get some kind of confidence as to how the system's going to do in real time. And so for the 11 years that are tested, there are 12 time windows in each year. And the neural networks system processes multiple different companies during that time period and then comes out with a prediction or signal strength. And then we see how well it's actually doing or not. Anyway, and we team them. So there's 100 neural networks. And say 50 means that 50 neural networks had to agree on a particular set of companies. And if it's 30, that means at this point only 30 companies had to agree on the solution. And then the curves are actually the return on investment. So for example, the first time window at let's say 50, teaming of neural network of 50 maybe got us a 3% return, something like that, maybe 2.5%. Then a time window of 4, which would be about 4 months later, it was around maybe 7.5%. Time window 3 was around maybe 12, 13%. And then the really top performer was actually the second time window at around 20%. And so this just kind of gives one an idea for throughout the year how the different how the teaming worked through the different time windows. So in this case, which is time window 11, it was actually a little bit below 0, it appears. You can see that time window 9 was around maybe 3%. Time window 10 was maybe 6%. Time window 7 was maybe 8% or 7.5%. And the top performer was time window 12. That's for this teaming area here of maybe 23%. Now, if you had a higher teaming number, it actually performed better at around 42%. Now you're going to have less companies that are selected the further out you go. But anyway, I could go into hours for how this works, but this is how it works as far as the historical forecast testing and then in real time. And so what we're doing is kind of like what Jim Simmons has done. I mean, mathematically probably very different from what he does, but the whole idea is that you make small profits per trade. So, for example, if you had a return on investment each time window of 3.44%, but then reinvested in the next time window or forecast window, you would end up with a 50% return at the end of the year. So it doesn't take large ROIs, return on investments, to get really high yields, in 1 year. And so in that sense, it's kind of similar. Or maybe the philosophy is similar. I'm sure the math is quite different. And so that's how this works, is we're just doing time windows of 20 trading days. And then when it's done, roll that money over, gain or loss, into the next one, and so on. And this is all, right now, it's just real-time testing. None of these stocks are being put out there as advice to buy. I'm just trying to put a timestamp to show that the forecast was made ahead of time but before the forecast window started, and then see how it does. Okay, so with the first forecast window, the first test set, this is what the 11-year performance looked like with the teaming of the neural network. So, for example, year 11, which was actually 2011, that's 2021, is just under a 50% return. In 2013, it was at maybe 80% return. 2016 at around 220 or so, 215% return, and so on. Obviously, it far outperforms the Dow Jones Industrials average. And again, this is in the past, so this doesn't do us any good because it's past data. It's testing on historical data, but the whole point is to try to get a feel for how the performance would be. In other words, if it performed like this in the past, maybe we'll get similar performance, in the future. And this is a close-up right here that shows we're scaled in from 0 to 100% or minus 10 to 100%. And this is the Dow Jones Industrial Average, and then the bottom part of the performance of the neural network system. And then if you break it down further, these are the 11 test years, but this shows how they actually got there. Like, in other words, how did it get to the 50% or how did it get to the 80%? And you can see there's some setbacks because there are losses. I'll go to here. This is actually the time window, the return on investment for each time window of 20 trading days. That's where all these little stars are. And so this is test year 1, test year 2, test year 3, all the way through test year 11. And you can see here that some of the returns, almost 20% of them were below 0. So you're going to at least have losses of 20% of the time. In some cases I've seen, it's maybe 30%. And then those that are above 0 is around 80%. So the whole point is that what we're trying to do is minimize losses, and then when we have wins, maximize those. And that's why, you have the higher ROIs, which propel you forward. Like, this is almost 20%. So when you do have a win in this case, it really moves you forward. Now, obviously, there's some lower ones as well. You can go several months with losses. So like in this case, this was probably 2 time windows of losses and then a couple more sort of slight gains and then losses, and then it really took off again. And that's just like with any trading. You're going to have losses. The whole idea is to try to have a bound in what you think those losses are, and then maximize your wins. So going now to the performance of the first forecast, there was actually 2 sets. This first one's actually ended up at 19 days into the 20-day trading window at 8.66%, which is not bad. The second one was around minus 2%, which is not great, but again, you're going to have some losses, and this is just getting started. Now, if we do the analysis of the data with the first forecast, there were 6 stocks that were selected, we have a minus 3% loss limit that we set, although I'm looking at maybe changing that to 5 or 8. I'm not sure. That's why I have to kind of look at the real-time data. But the idea is that you cut your losses early. So in this case, these 3 stocks hit the minus 3 loss limit level, and so they were assumed to have just been sold off, and you have the minus 3%. So at the end of the 19 days, this stock went up 20%. This one just was around 1%, and then the big winner was VWTR, which ended up at almost 40%. And so the mean was 8.67% at the end of the 19 days. Now, if you invested, and the other thing is that you invest the same amount of money into each stock. So let's say you put $1,000 into each one. Your initial investment would be $6,000, and then at the end, it would be $6,520. Now, with the second forecast, we actually were at a loss. This stock, we didn't lose anything, but we didn't win anything. And these 2 tapped out at the minus 3 loss limit level. So if you'd invested $3,000, because again, it's $1,000 per stock, and it doesn't have to be 1,000. The whole point is that you invest the same amount of money into each stock. You don't buy 100 shares of each. You buy the same amount. You invest the same amount of money. And so in this case, it would have dropped. But interestingly, if you combine the two, since the two forecasts were done at the same time, let's say you invested all the money together. So you would have had a 6,000 invested in the first forecast, and then 3,000 in the second forecast. And you had wins here, came out positive, and had some losses here, but then you tally it all up, you'd still end up with an aggregate return on investment of 5.11%, which is not bad. So I'll go over the first forecast, which was on these 6 companies that were mentioned, and it was actually, it's a little bit late. It was 9/11. I think that was CST. So the markets had already opened. And it was my first time getting started. What I normally like to do is get this done on before the markets open, and that's the way it's normally going to be. But still, it was a little bit after the market had opened. And again, this is going over the mean return on investment for that first forecast set, and these are the numbers. Now, if we look at the individual stocks, VWTR was the big winner, and that was the one that really drove everything. And that's typically how the system works. There's 2 or 3 superstars that really drive the rest. So this one ended up almost at 40%. So you would have bought it around $12.30, and then sold out at $7.16. Now, some people are going to say, well, you've got the spread between the bid and ask, and that's going to reduce your percentage, and that's true. So in this case, let's say your spread between the bid and ask is half a percentage point. I mean, I don't think it's going to be that much, but let's say it's half a percentage point. So instead of this being at 8.66%, it's going to be at 8.16%, which is still great. Now, I know you have stock transaction fees, but you're going to have that for any stocks. And so even if you subtract from that, this is still doing a lot better than most traders, if you could do this on a consistent basis. So going back to the stocks individually, this was VWTR. Now, this was one of the ones that was kicked out. This was KOPN. It's kicked out on the first day. So this shows the actual performance or the price profile of the stock, but the system kicked it out at minus 3%. And that actually happened on the first day when it hit the low. So this was kicked out. This kept going, DOX, but never really did anything. I mean, the highest was around maybe just under 3%, but it's just kind of sitting there. So it didn't really contribute much. It helped pull up the negatives, but that was about it. Another one that was kicked out was BWA, and that was on the third day. And here's the price profile, but it was kicked out when it hit the low. And so that one was just a permanent minus 3% loss. ASML, same thing, except in this case it was on the 12th day when it really started to drop, and then it hit the loss limit of minus 3%. So that was just, for the rest of the time, would be considered a minus 3% loss. ARLP actually performed the last few days, went up from around 5 to 6% and climbed to about 20%. And so that's where you got, the ones that generated the big moves would have been VWTR and ARLP to end up with this performance right here. Now, looking at the second forecast, that was actually published at 11:25 a.m. So yeah, the market had already opened, and normally I want to have these done a couple hours before the market opens, or sooner if possible. If it's a weekend, like for a Monday, I'll have it published on Sunday. But if it's during the week, it'll just be 2, maybe 3 hours before the market opens for timing purposes. In this case, the stock is right around the portfolio is right around minus 2%. These are the numbers. CIF just kind of stayed the same. These two were kicked out because of the minus 3% loss limit, so this was definitely a loss. VHC was kicked out the first day. It's a pretty volatile stock. So you can see right here, first day when it was bought, it was kicked out during the day. Second one that was dropped was NTP on the first day as well. Also, you can see right here for the low. Even though later it recovered to about 11% and then pulled back, and right now it's around minus 2%, but that would have been kicked out of the portfolio. So the only one left was CIF, which at one point was at over 4.5%, and then comes back down, and now it's around 0. So that's just is what it is. So in conclusions, this was the first forecast. This was the second. And if you did an aggregate return, it's 5.11%, which is pretty good. If you took 5.11% and if you achieve that every month, you'd end up with an 81.9, almost 82% ROI for the year. So small profits are not bad. Now, normally what you would do, though, is you would just have one investment pool. You would do one forecast, stay with that for 20 trading days, then sell it, then turn it over and start another one. So these would be two separate pools but I just combined them just to see what it would look like. I just happened to put out two forecasts that day. But the whole idea is that you make small amounts, but consistently. So in this case, I said if you had a 5.11%, you'd be almost 82% return. Now, if you'd had the 8.67, which was the ROI from the first forecast, if you consistently did it, you would have 171% return. But the odds are you're not going to consistently do that. But let's say you do something like 3.44%, much, much smaller, and consistently. Some months you're ahead, some months you're behind, but let's say you average that. Well, you're going to still end up with a year-end of 50% ROI. So the whole key is compounded interest, so to speak, compounded ROIs, because you keep reinvesting it in the next one, the next one, and the next one. And so the principal that you invest keeps getting bigger each time. So that 5% or 3.44% down here invested is a much bigger return than back here because your principal's grown. And again, we go back to how these can move during the year. I can show some other examples. Well, like here we have some losses. This is right around the teaming of 80. So this is a -3. So if we had used a teaming number of 80 in the fifth time window, which is about the fifth month, we would have had a loss. And there's other cases where there's more losses. They don't always look like this. And there's some losses here too, obviously. So you're going to have some losses and some wins. Just like I showed earlier, this is an example of the losses. It just gives you an idea of sort of probability-wise. In this case, it's basically saying that, on a very rough basis statistically, that you have 1 in 5 chances of having a loser, but you have 4 in 5 chances of having a winner. However, a winner may be close to zero because you can see some of these ROIs are near zero, and then the probability of having the higher ones gets less. But still, when you look at the historical forecast tests, they all end up getting propelled forward quite a bit, much beyond what you're going to get with the market indexes and so on. So I would say overall the performance of the first forecast was really good. Performance of the second one wasn't so good, but it falls within the statistical probability that you're going to have some losers, and it was only 2 cases. And so I'm putting these out. It's going to be about once a day, so it'd be like Monday through Friday, so that I can build data points and start seeing if statistically the real-time data lines up with the historical forecast data. In other words, do you have approximately, say, 20 to 35% that are losers, and then approximately 80 to 65% are winners, and is it enough to give you the large returns of 50% ROI at the end of the year or beyond? So that's what this is all about. I'm sorry I had to go so fast, but there was a lot more material that could be covered. But this is kind of just a summary of sort of the performance of the first 2 forecasts that were done starting on March 21st. So that's it.